between RES, the Society for Professional Economists, Filippo, who is here somewhere from SPE, give us a wave, and the Resolution Foundation. When we started planning this event back in April, it was just after Liberation Day. We all thought, who's going to get a tariff? Who's going to get a deal? And here we are in July, and we're still discussing who's going to get a tariff, who's going to get a deal. So the only certainty seems to be the uncertainty. And I suppose another certainty is we are in a new world order. So I think that bit of the event title we got right. So I'm delighted to be here. We've got a fascinating panel, and I'm going to hand over to our chair for the evening, President of the Resolution Foundation, David Willetts. Thank you, David.
Great. Thank you very much. Welcome to Resolution Foundation. We're delighted to be hosting this event in partnership with the Society of Professional Economists and the Royal Economic Society. We're delighted to have three very distinguished economists on our panel. We at Resolution Foundation work on economic and social policy, and our output is charts. So I thought I would just share with you three resolution charts which touch on some of the issues we're going to discuss today. The first is this interesting paradox that at the time of Brexit, we thought there'd been all these negotiations around focused particularly on trade in goods with the EU, and that goods would be looked after and the problem would be services. If anything, it's gone the other way round, and manufacturing has suffered particularly badly compared to other advanced Western countries, and services we've done rather better than we expected. Particularly, and that we've done some further analysis of this at Resolution Foundation, unregulated service sectors. So it looks as if services where there is minimal regulation, PR, advertising, areas like that have done particularly well. So that's the first chart. The second chart, as this is the day when we were expecting to know the final details of all the tariffs, just a reminder of the sectors of British manufacturing which are particularly exposed to the US and where a trade deal with the US would be particularly important. Interesting how pharmaceuticals and automotive score so highly as very exposed to the US market. And then thirdly, because we do think a lot about living standards and incomes and their distribution here, the picture that for services, for tradable services, there is a group of people who do particularly well. We know they tend to be concentrated in areas such as law and finance, and also concentrated in London. You can see how there's some very well-paid jobs in that tradable services sector. But tradable goods does pretty well for a much greater geographic distribution than services, and quite a lot of decent, pretty well-paid jobs. If you want well-paid, middle-of-the-road jobs distributed widely across the UK, tradable goods scores quite highly. Of course, it's now a relatively small part of the economy, but it does score very highly. Just three observations from us at Resolution Foundation. It now gives me great pleasure to introduce the first of our three speakers, Professor Meredith Crowley, Professor of Economics at the University of Cambridge, President of the International Economics and Finance Society, and before that she has worked in the US as well in the research department of the Federal Reserve Bank of Chicago. She's taught at Georgetown, she's taught at Shanghai, and I'm delighted that Meredith is going to set the ball rolling. Meredith, over to you.
Okay, thanks very much, the Resolution Foundation, the RES, and the Society of Professional Economists for asking me to come talk to you today. So I very much approve of the title of the panel discussion, A New World Order, because I think that we're going to see a new world order emerging, whether it's over the next 10 years or a longer time span. I think the move of direction is in a new direction. Where it will land, I don't yet know. But so what I'd like to do in terms of discussing and thinking about where the world is going, I'm going to provide some background around where we came from, and then outline what I see as the major concerns of three large parties and sort of the chaos we're in right now. So this is just to say what I describe as the world trading system is an overlapping network of international trade treaties that govern trade in goods and to a lesser extent trade in services. And so the foundation upon which all international trade treaties are built is the General Agreement on Tariffs of Trade, drafted in 1947, a few blocks from where we are now. It was set up between the US and the UK with 21 other countries as partners. Some we now call high-income countries, some were middle and low-income countries. Now, this framework or foundation of the GATT treaty ultimately evolved to become the World Trade Organization, but every other major instrument that governs trade, such as the European Union, the Comprehensive and Progressive Trans-Pacific Partnership, they're all built upon this foundation of the World Trade Organization. So the foundational principle of the multilateral trading system under the WTO is what's known as reciprocal and mutually beneficial tariffs. So if I am in the UK back in 1947 and I would like to export something to the US, I ask the United States, can you lower your tariff on automobiles? I'd like to send you some. The US would say, okay, that's fine, but what we want to send to Britain is airplane parts. So can you reduce your tariff on that? So that was what was meant by reciprocity and is the principle of reciprocity that has guided trade negotiators for the last 70 years. President Trump is using these words in a different and new way, but that's sort of the traditional way. So what did this system give us? So over 7 decades, we had an explosion of global trade. In this graph, I have the trade to all economic activity ratio. So this is exports plus imports for all WTO members, divided by 2, divided by the GDP of all WTO members. And here I show the graph starting in 1995, going to just about today. What you see is part of the big transformation that hit the world economy, really starting back in 1980. But the trade to GDP ratio, trade as a share of all activity, was rising from 1995 up until the cusp of the global financial crisis in 2008, 2009. At that point it tanked, and since then it's been bobbling along between 25 and 30%. So this is known as the Great Trade Slowdown. Some trade economists call it globalization. The red vertical line is the start of the US-China trade war. So you can see that is another kick in the system. Now, what is the multilateral trading system? Here I've got a table of data. This is from before the trade war started, before Brexit. It's data from 2013. And it's a summary of the commitments different WTO members made to one another. The top half of the table summarizes the commitments of high-income countries that are members of the WTO. The bottom half shows the commitments of middle-income economies that are part of the WTO. So what I have highlighted in yellow are the commitments by the United States. And the most sort of useful number is if you look in the first column, 3.4%. That is the average import tariff rate the US charges over all 5,000 roughly commodities that the US imports in any given year. The second number, 3.5%, is what the US has promised the WTO would be the maximum average rate. So pretty much these numbers for most of the high-income countries are pretty similar, meaning that they make big commitments to open their markets and they actually implement them. Now, if you move to the bottom half of the table, things start to look a little bit different. The first notable feature is that most middle-income countries have in the first column as their average tariff rate something between 7 and 15%. But if you look at the second column, and if you look at Argentina, which is the first middle-income country, you'll see the second number is 31.9%. So what that means is that when Argentina made its commitments to the WTO, it was a little bit nervous about opening its markets. It said it was going to set a tariff on average around 30%, but actually they realized it's not in Argentina's best interest to do that, so they implement a tariff that's a bit lower. This is what you see for most middle-income economies. This means that if they feel like they have over-opened their economy, and for some reason, whether it's macroeconomic imbalances, high unemployment rates, a recession hitting, they want to raise tariffs, they can do so under the WTO rules. The outlier here, highlighted in pink, is China. China joined at a later point in 2001. The US and the EU, as sort of the leaders in their negotiations with China, insisted on much more open commitments from China. So their import tariff rate, their commitment at the WTO is 10%, and they more or less have been implementing this. So that's how open their markets are in terms of trade policy. So the big picture story here, though, is that the high-income countries are, as a fact, more open to trade than the middle-income countries. How have they been able to support and sustain such openness? Why are they doing it? Well, one part of why they're doing this, or how they've been able to sustain this open liberal market system, is through a series of loopholes that are part of the WTO contract. So if, for example, the US decides they're importing too much steel, it's a recession, they don't want to lay off steel workers, they don't want to use domestic tax transfer programs to protect the steel industry, they could use a special temporary tariff on steel. And this has been the system as it's set up since the beginning. And what you see in this picture is that for the European Union and the United States, in any year between roughly 1990 and 2013, on average, the EU, the horizontal dark black line is at about 3%. That means 3% of the roughly 5,000 commodities that can be reported as imported goods have a special import tariff in place in the EU. For the US, it's a little bit higher. It's roughly about 5% of tariff lines going into the US could use a special import tariff. So in some ways, the sort of big picture is that what kept the multilateral trade system open and liberal from the high income market side was that they had this contingency loophole that was available to them. And that allowed the system to proceed as it had. So where are we today? What's gone wrong? Well, China's entry into the world trading system has been more disruptive than people anticipated if we think back to 1995. Between 2001 and 2021, China's exports to the world grew by a factor of 8 compared to overall global trade, which grew by a factor of a little less than 2. Interestingly, on this figure, which is a summary of data from the universe of customs transactions from China, it goes from 2000 to 2014. The light gray line represents exports originating from foreign invested enterprises within China. This quantity in any year is roughly half of all export value leaving China comes from firms which have foreign investment from Taiwan, Hong Kong, the European Union, the United States, the UK. So some of this is a success story. Production in China very well integrated with the high-income world, and this led them to be a fantastic export source for much of the world. Now, not everybody has been happy with China's rapid increasing growth in world trade. In the US, the narrative that's taken hold and captured the imagination of politicians is that China is the source of US job loss. This is a picture from a famous study by Otter, Dorn, and Hansen, a team based at MIT. The red dotted line shows you the manufacturing to employment population ratio. In the United States, if we extend this out further 20 years in either direction, this number is going down over a much longer time, and it looks a little bit like a staircase. So when you hit a US recession date, manufacturing employment to population drops sharply, and then it continues downward. At the same time, China's imports, especially during this period, were growing rapidly. Subsequent economic studies have chipped away at the magnitude of this study. They've noted some shortcomings. Part of the reason why workers were leaving manufacturing in the US in this period was they were being drawn into a housing boom and construction jobs. There's also technology changing. The US is a great place for adopting labor-saving technology. But the story that's really captured the imagination of workers and politicians is job loss, and that it's China's fault. In the European Union, there are other anxieties about China. I'll just point out one. More recently, there's been this talk about strategic dependence and can we trust the person we're importing from. So the picture here is just one example of one market. The EU is very pro-green technology. They're very concerned about climate change. Here we have extra EU imports, so imports into the EU of green technology products. The blue line is solar panels. Europe was an early developer of solar panels. However, given there were extensive subsidies by China, by 2012, roughly 80% of the European market for solar panels was coming from China. This was killing the domestic European firms. The European Commission responded by imposing temporary tariffs on solar panels. That's why you see the blue line fall quite sharply. It stays low from 2012 to 2018, while the European Union has these tariffs in place. As soon as they remove them, imports of solar panels bounce back up. So there's there's a number of things we can say here. One is solar panels are really cheap in Europe and they're everywhere now. So China's rapid technology development is a good thing if you want to disseminate a new technology cheaply. But if you're not convinced that they're going to make those products available to you tomorrow, you might be very worried about dependence. The other thing is that the use of a temporary tariff to try to rebuild the European industry was ultimately ineffective. So these loophole tariffs that I was mentioning earlier, they didn't help the Europeans achieve what they wanted to. Now, while the US and European Union have been dissatisfied with how China's integrated into the global economy, China also has its own dissatisfactions. So this shows the foreign value added in China's gross exports from 1995 to about 2020. This is data from the OECD. What you see is right when China joined the WTO in 2001, the amount of foreign value added in what they exported grew quite dramatically. This led the Chinese to adopt a number of policies to transfer that technology and more sophisticated manufacturing into the Chinese market. They wanted to make the most high value added products themselves. What they were calling inward technology transfer, the United States, the European Union, Japan, the UK said this is illegal infringement on our intellectual property. This has been a sort of irreconcilable difference between the high-income democracies and China. Where are we now? Well, American cooperation at the WTO began to falter around 2009 when President Obama was in post. He turned away from the multilateral system and tried to pursue other avenues for policy development that he thought would be more productive for the US's ultimate relationship with China. The long thread of American policy went from Obama turning away from the WTO system softly to Donald Trump saying enough is enough, we're going to put tariffs on China because we're dissatisfied with how the WTO is managing and helping us manage our relationship with China, to Joe Biden, who said we're going to keep Trump's tariffs in place, but we're going to introduce industrial subsidies, and we're going to specifically make these available only to countries with which the U.S. has a solid and deep economic partnership, so countries like South Korea, Japan, Canada. And then ultimately, we end up where we are with the second Trump administration. So now President Trump, I think, feels that tariffs didn't show many negative consequences in his first administration. He did not like the Biden approach to industrial subsidization, so he's killed that. He believes that tariffs can be used to raise tax revenue and replace other types of taxes like corporate income tax on high, wealth people. So he's taken a big, he's kind of thrown all his eggs in the tariff basket. And I think as we think forward to where the world can go, I realize I'm going over my time here. I think the big question for the UK, for Europe, for China is how do we get back to a situation in which there can be a more productive trading and economic relationship? In the long run, I don't think the US wants to have such an antagonistic relationship with China. And so the question is, what structures do we need to put in place to build this sort of newer foundation?
Thank you very much. Thank you for that excellent account of what's been going on. Of course, the US themselves failed to nominate the people to ensure that the WTO would continue to function.
Intentionally. Yeah, no, that was part of the stepping away.
Yeah. Let's now hear from Sherman Robinson, Senior Fellow at the Peterson Institute for International Economics, who's worked at several academic institutions, including the University of California at Berkeley and at the London School of Economics. And I think recently have been looking at the impact of US deportation policies on the economies of North America. So over to you, Sherman.
Okay. All right. We are. Okay, this is from the Peterson Institute. This is going to follow very nicely. She saved me a lot of time. Basically, what I'm going to give a gallop through a lot of trade history from the post-war period. So what we look at in the post-war period, we've been looking at trade shares, big matrices of trade shares across countries by commodity, by whatever. And what we see is the emergence of three clusters. And there's the math behind finding these clusters is interesting in its own right, but for your interest, it's the results. You ended up with three integrated, what we called interconnected regional economies. North America, US, Canada, Mexico, Europe, EU plus its periphery, and this emerging really behemoth in East and Southeast Asia. That's China, Japan, Korea, and all the way down to Australia, New Zealand. It really was occurring fairly quickly during the post-war period, for late in the 70s. But it really took off when, first of all, Great Britain joined the EU, and you could then see Australia and New Zealand moving into Asia in a way. And then China, liberalization of China. What's intriguing about these trade blocs is they emerged in the data way before the agreements. Basically, what you're observing is that all these free trade agreements we've been having, and indeed within the EU, the various completing the common market and all that, they followed the trade data by decades. So here's basically we look at bilateral trade and GDP, and this is a table of global trade, global exports, imports have to equal exports, adds up to 100 for the whole table. And what you observe is these three groups, US and the rest of NAFTA, 25 to 30% of global GDP, 10-14% of global trade. Europe roughly used to be a bit more, again, about a quarter of global GDP, but 36% of global trade. And then East and Southeast Asia, again, if you add up China with it, it's about now 30% of global GDP, and a big share, another 20-30% of global trade. Thing to note about that is how small the U.S. trade share is in world trade compared to the other big ones. And then you have everybody else. You can see, if you look at the data, you can see little other clusters, but they're never ever integrated. You can see Southern Africa, Mercosur, but they're much more diversified. India is interesting. It's never joined. I expected India to join Asia, and it didn't. It's a very diversified trade structure. This table, here it is by when we take out the intra-regional trade. We do not count trade between California and Texas as foreign trade, but we do count trade between France and Germany. So let's take that out. And you get roughly the same story. It's US NAFTA is 14-15% of global trade. The others are still big, or double it roughly, even when you net out the intra-regional trade. If you look at the trade shares, what defines these integrated units is the members trade more within the trade unit than they do externally, outside. So every country in these trade blocs, its share of trade within the trade bloc is bigger than its share with anybody else outside, and you can see that here, in all of them. So you can see well, you can just see it everywhere in that system. That's important because it tells you how important that, for example, the East and Southeast Asia bloc is. China is an anchor country in that bloc. When you look at the early data, China tended to be the export platform for the bloc. It would get a lot of intermediate products and everything coming, and then it would do the final assembly and export. That's changed in the last 10, 15 years. Now China is just much more heavily integrated with value chains going both ways from China and the rest. But China is anchored in that bloc. Same thing, if you look at the bilateral trade shares, you can see the same basic story coming out. That's important because when we look at the U.S., you've already basically told me, this is just pursuing the data a little bit. Basically, the U.S. has these safeguards. Basically, Trump is now in violation of every trade agreement the U.S. is involved in, including North America, in fact. So you've got that going. The current round of trade agreements, you think of a trade agreement as a negotiation, you follow, it's a contract between consenting adults. These are not. This is really dealing with extortion. I mean, Trump puts on something, you have to go approach him. He's divided up, every country has to come individually, which is exactly what you'd expect for this kind of thing. We're not in a world anymore of trade agreements. Now, what's interesting about this, though, is one question is, and you see all these things in the papers about, is this the end of globalization? Is this the end of the global trading system? And the answer is no, it isn't. It's what you're observing is the U.S. withdrawing, but nobody else is. Everybody else is making deals all over the place. You're seeing all sorts of deals, multilateral pairwise within East and Southeast Asia. The U.S. pulled out of the first version of the Trans-Pacific Partnership. Within a year, the remaining members had created the CPTPP. And now it's expanding with Great Britain is a member, China is in line, Korea is talking about it, and there's even talk within the EU about what it would be like to join. So you're not seeing the end of the world trading system, you're just seeing US withdrawal. So then we did a whole bunch of simulation models. This database provides a lot, and we're simulating global trading systems in big multi-country simulation models. And basically, we get a lesson from this work. One is, if you have trade wars, and this started earlier, what should happen to poor countries? That's one of my interests. And the answer is just stay out. Don't get involved. And gain from trade diversion, because what you're seeing is a lot of trade diversion. Canada and Mexico, unfortunately, are trying to diversify their trade as we speak. They are really working hard on it, but they are really tied to the U.S. There's a phrase in North America that says the U.S. gets a sneeze and the rest of Canada and Mexico both get pneumonia. But they are trying. The other point, though, is the U.S. is not that big a share of global trade. When we simulate really serious withdrawal, big tariffs in the U.S., like of the sort, or other things than not just tariffs but non-tariffs, it's not that difficult for the rest of the world to divert trade around, away from the U.S. And we're seeing that, and it takes a while. You're going to have winners and losers while you're doing it, but it's not going to be the end of the world. We do not, for example, see global trade falling that much when we simulate this. It's diverted away from the U.S. So, where are we going from this? A lot of concern with value chains, and that some of the concerns you mentioned is dependence on value chains, and this has been a fair worry that you have bottlenecks in the trading system. So you are seeing that reordering trade and value chains. A lot of new trade agreements going on. They are at some point supplementing the WTO. The WTO is at an absolute standstill. The Trump administration destroyed the appellate process in the WTO. Biden made no effort to put it back. and it's just basically frozen. So trade disputes are hard to do. What's happened within the WTO is a group of countries in the WTO said we do need a dispute resolution mechanism, and they've created a small one among a group of countries, of which Britain, I think, is one. China's in it. We're going to have to look at the international finance. That's not my field. The other half of the Peterson Institute is full of macroeconomists, and we'll be hearing about some of that. So, and the other one we're starting to worry about is that the U.S. is in the process of really not just withdrawing from the global trading system, but the global labor markets. We're not going to take any more graduate students. We're deporting like crazy. We're driving labor markets, labor underground in the U.S. All of this just adds a whole lot of uncertainty and volatility to the global system, which it doesn't need. We have no idea how that's going to play out. That's something we should probably discuss.
Thank you very much. Thank you very much, Russell. And now, Sherman, now we hear from Russell Napier, who is an independent investment strategist, founder of Orlock Advisors, author of the Solid Ground Investment Report, and who has been advising global institutional investors on asset allocation since 1995. So, Russell, over to you.
Thank you. There is a new world order coming. It is coming because of a change in trade, but that's not why we'll remember it, because we'll remember it because it's a change in the monetary order. So the change that is being enforced in trade forces China to change, forces China to reject mercantilism because it's clearly not a process of growth, forces China to have a monetary policy, not unlike America, the United Kingdom, Europe, a monetary policy focused upon the price and quantity of money rather than the exchange rate, and the world will never be the same again. So it may have begun with trade, but it doesn't end with trade. So trade wars are capital wars. If one is going to reallocate trade balances, one is going to really allocate capital flows, and that brings us the birth of a new monetary system. We need to talk briefly about the old one, because if I asked you to give me the name of the current global monetary system, I think you'd probably be struggling to do so. Paul Volcker, who was a smarter man than most, had a name for it. He called it the non-system. And to Volcker, the monetary system we ran with for 30 years was the non-system because it didn't have a name, but more importantly, it was never negotiated. Not like Bretton Woods. There were no limits on the free movement of capital imposed. There were no constraints on how big a deficit you could run. Some people ran flexible exchange rate regimes. Some people ran managed exchange rate regimes. To Volcker, it was the biggest possible conceivable mess and would lead to massive imbalances, and that's exactly what happened. So if we're going to move away, if the trade restrictions are going to take us to a new global monetary system, I want to begin with the imbalances it leaves behind. Because if you're going to forecast what the new global monetary system will look like, it's going to have to be based around how do we cope with those legacy imbalances that are there. So this is what the non-system did. It began with China, of course, in '94, running massive external surpluses, pouring those surpluses into the fixed interest securities of the developed world, particularly America, but certainly not exclusively America. By '98, with the Asian financial crisis, as soon as it was over, many other Asian countries did exactly the same thing. We even had countries like Japan, Switzerland, Norway, all accumulating foreign exchange reserves. Ask an economist what central bankers have been doing for the last 30 years, they'll say inflation targeting, and it's nonsense. Oh yes, some of them did, the Fed did, the United Kingdom did, the European Union did. But many central bankers did not do that. So we had these two bizarre systems living together, which nobody would ever have planned. So what were the consequences of one set of central bankers running inflation targets, one set of central bankers running exchange rate targets? Well, you had basically a depression of the risk-free rate below the growth rate, a decoupling of the two, because the accumulation of reserves is a non-price sensitive purchase. None of these reserve managers were looking at the growth rate of America, the inflation rate of America, anything to do with the ability of France or Germany to pay them back. They were on autopilot. And if you begin to decouple the risk-free rate from the growth rate, you're going to get imbalances. And that's exactly what we have. So the ones I'll focus on, and usually this would take 90 minutes, but the ones I'll focus on would be debt, It is noticeable that most of the debt metrics in the developed world start to go like this from the mid-1990s, almost to the day that China devalues its exchange rate and begins to accumulate foreign exchange reserves and also overvalued assets. And those overvalued assets are particularly in America. Once again, you look at a measure of long-term value for US equities, such as the cyclically adjusted PE, such as the Q ratio, and something happens in the mid-1990s. And what happens is we put this in place, but it's all driven by trade. It's all driven by the ability to run trade surpluses. China enters the WTO, its trade surpluses get bigger, the imbalances get bigger, and that's the system we run with. And politicians in the West did nothing about it because on the whole it was fairly beneficial. Discount rates were lower than they should otherwise have been. Gearing was freely available. Inflation was low. And one of the critical elements of all of this is that China, obviously in a Bretton Woods system, would have produced a huge amount of excess reserves in the commercial banking system that would have found its way as bank credit, that would have found its way as higher money supply growth, that would have found its way to higher inflation, and China would have whittled away its external surplus, and we would have had some rebalancing within a system. But the ability of the Chinese to run and own the financial system itself, owned by the state, and to channel primarily the growth in bank credit towards ever more investment, ever more production, not necessarily ever more consumption, meant that the system went on and on and on and on. So the imbalances got bigger and bigger and bigger. So that's the old system. So and what I'm going to do briefly is say why it doesn't work for China and why this trade war makes it even worse for China, why it steps away from it, and then what happens next. So there's a series of charts here. On the legacy, that's US total debt to GDP, not government debt, total debt. So government plus consumer plus non-financial corporations, much higher than 1947, way above World War II levels. And this is the legacy. If you're going to set up a monetary policy for this economy, you have to set up a monetary policy that can inflate away those debts. This is not the period post-Napoleonic Wars. This is a democracy, and it's going to have to inflate them away. And I'm not pointing fingers at America because most countries are worse than America. There's the American number that I've just shown you on that chart, 249% of GDP. But lucky America, at least it's not France or Japan or China. China now has a much higher debt to GDP ratio than the United States of America. And this is where I'm saying it doesn't work for China. If you begin to align to reduce China's external surpluses, what you force it to under the existing exchange rate management policy is deflation. And this is a country that's already deflating, and now we have this targeted attack on its external accounts. So this is a global developed world problem. It's not an emerging market problem ex-China, which is why I popped in India there. So that's the legacy. Whatever the new global monetary system is, it's going to have to begin to deal with that legacy. But it's not a US problem, it's a developed world problem. So the Trump administration is trying to restrict China's surpluses, not just by its own direct action against China, but look at the British trade deal. The British trade deal has a line in it which says that Britain and the United States will get together to confront non-market economies. Well, that's a euphemism. We all know who the non-market economy is. Every American negotiation has that clause. I'm not saying everyone's going to endorse it and everyone's going to put it in, but everybody's being asked to gather together with America to confront the non-market policies of an unnamed country. I don't think we've seen the details of the Vietnam deal, but it will be, very incendiary if that's in the Vietnam deal. Ursula von der Leyen's speech 2 weeks ago makes it pretty clear that the European Union, I think, is happy to sign up to such an allegation or a commitment. Now, it's just a commitment. There's nothing, this deal is not really a deal. As you know, it's a heads of agreement. But it's a heads of agreement that there will be an alignment against China. What does China do in this scenario? Does it continue to manage its exchange rate, except that it's not going to be running surpluses and expanding its balance sheet? So what China needs to do is expand its central bank balance sheet to create more money, but it's failing. It's failing spectacularly to do so because it launched such a policy last August with the direct impetus from Xi Jinping, and they cancelled it in January because it was obvious that you couldn't do two things at the same time. You couldn't get your central bank balance sheet to expand by buying local bonds and at the same time be in the business of managing the exchange rate, so it failed abysmally. And here's why they had to cancel it. This is the growth in foreign exchange reserves. It isn't happening. There isn't any. China may be running this large trade surplus and this large current account surplus, but its capital account means that you have a country managing an exchange rate unable to generate growth in foreign exchange reserves. Here's the growth in the central bank balance sheet, reserve money. Virtually no growth since 2014. But in the last year, as we've tried to reflate the economy, it's contracted. How can you contract reserve money of the central bank if your business is to reflate the economy? Because you have to if you want to manage the exchange rate. How does this relate to trade? The more Trump and others align to constrain Chinese trade, the more they align to constrain Chinese monetary policy, if China insists on running a managed exchange rate regime. So why should China hand this lever of deflation to its enemies, people who basically publicly now declare it as enemies? This is the total debt to GDP ratio of China. Back to 2007, it was roughly half the level of the United States of America. Now it's significantly higher. This is the only country in the world with a rising debt to GDP ratio. That inflation surprise we had, that high nominal GDP growth, combined with a collapse in the price of debt, actually has brought debt to GDP ratios down in most economies. This economy is still going up. The debt trap is still working. And by concentrating, I think Scott Bessent in particular, by concentrating on China's external accounts, knows that they can drive China deeper into this. China's short-term interest rates, I put it up because they haven't actually been very successful in bringing them down, which one would think if you were trying to reflate your economy, you would do. So they try that in August and they make no headway whatsoever. There has been some headway recently since April, but there are days when Chinese short-term rates actually are higher than they were before this alleged reflation began. It doesn't work for China. That's the growth in broad money, one of the lowest levels they've had. That goes back to 1996. That's the same data, but a little bit closer to where we are. So, nothing really going on with that form of reflation. Bank credit is the source of all money growth or all broad money growth. It's not growing. It's not picking up. It's the lowest level ever recorded. Their debt service ratio has reached an all-time high. The Chinese government bond yield close to an all-time low. Where's this reflation that was launched last August? Why is it failing? It's failing because of the concentration on the exchange rate regime. The CPI low. As of this morning, actually, this has now gone, the PPI has gone to minus 3.6%. So China's in a corner and the trade war makes it much worse. So here's what happens if China moves to the same monetary policy as New Zealand. I like to pick on New Zealand because it's a very small country, but even New Zealand has an independent monetary policy with a flexible exchange rate. Why shouldn't the second largest economy in the world have that if it sees the rest of the world ganging up against it in terms of trade and therefore deflation? So it would do this simply to have the flexibility to create as much money as it needs to create the level of nominal GDP growth that it needs to bring down its debt to GDP ratio. That's what we all do. That's what we all do when debt to GDP is too high. That's what happens. So when they do that, the exchange rate would fall because the growth rate in the supply of renminbi, currently at 7% per annum, would probably escalate to 15%. But the rest of the world couldn't cope with the trade consequences of that, so protectionism gets higher with a lower Chinese exchange rate. But China is enfranchised with an independent monetary policy to pursue its own domestic reflation through consumption or whatever else. So what that means for the rest of us is we have to live with a world where the natural tendency now is for our discount rates to go up and our growth rates to come down. And frankly, we can't live with that world. So we revert to Butzkelism. And Butzkelism is also financial repression. In other words, and it's already in the British legislation, it will be here by October. It's called mandation. And under mandation, a British government minister can tell the pension funds what they should buy. Currently, that looks like motherhood and apple pie because it's aimed at British growth assets, but quite as easily it could be aimed at British government bonds. So the only way we cope with the legacy of this is inflating away debts, which is to forcefully hold down the yield curve while nominal GDP growth is higher. And that's a rerun of that 1945 to 1978 period. Now, I've only got 2 charts left, so that will be quick. Here's another legacy of this. This is US net portfolio assets to GDP. So the other thing that happened in this period is massive diversification of capital flows all over the world, but a huge concentration on the United States of America. So this is the balance sheet of America. It's all the portfolio assets offshore owned by Americans, private and public. and all the US portfolio assets owned by foreigners, owned by both the foreign official sector and the private sector. And you can see right back at the beginning of the great financial crisis, it was only 20% of GDP. The data came out last week, it's now minus 58% of GDP. In the world of mandation, where people have to bring capital home to meet investment targets, where the Germans issue 300 billion euros of bonds and something has to be sold to finance that, when every country has an industrial policy and needs to fund its industrial policy, what do they sell to raise the capital? We get a retreat back to home bias, and the necessary and the obvious asset to be liquidated in that are the portfolio assets of the United States of America, both equities and bonds. And just in case you think that only America has this problem, there is one other country that stands out as having this problem. France. Incredibly, France has gone from a surplus on this to a very large deficit, probably because so much capital was pouring out of Germany in their period of fiscal conservatism. But as Germany goes through a major investment boom, government-driven plus private sector-driven, expect German capital to be selling overseas assets to buy domestic equities, domestic bonds to finance the new industrial revolution in Germany. So that is the new world order. It's trade's the trigger, but it forces China to do something, which forces all of us to do something. And we're certainly not in Kansas anymore.
Thank you very much. Thank you for bringing that financial perspective to the issue. I think before I just turn to the wider audience, and do feel free to come up with your questions and answers, I thought I might just ask both Meredith and Sherman if you want to comment briefly on the financial analysis that we've just seen.
So I would say two points I want to make. One is that when I think about the New World Order, one of the big changes, and we've talked about two aspects, the financial side and the trade side. The other side has to do with the flow of digital services across borders and the huge role that multinational corporations play in the economy in general. So they're responsible for about 2/3 of global GDP. But there's really two places in the world that have very large providers of digital services. This is the United States and China. And the existence of tax havens changes the flow and erodes the tax bases of pretty much anywhere else in the world that's not the US or China and is not using a tax haven. So one of the complications that we see with policy as it's evolving, for example, Canada tried to impose the digital services tax this year, which would tax the revenues of large US corporations like Google, Amazon, when they provided services to Canadians. When President Trump sat down with them to negotiate trade deal, he said, point one, no more digital taxes on American firms. And if you do that, we're stopping the deal. And so this is, in some sense, I think not very welcomed for one democracy to be telling another democracy what they can tax, especially when there's this tax-based erosion problem. The other thing is to do with global payments systems. So it's a very live issue on this side of the Atlantic right now. There's high concern within the European Union, to I think some extent in the UK. What happens if the President of the United States says we want to put some restrictions on the use of US payment systems? So for example, Visa and MasterCard command a huge amount of payments within the European Union. The US began in 2001 to use financial sanctions in the wake of the September 11th attacks. They were going after Osama bin Laden. They started to stop any transaction linked to him that went through New York, which was basically any financial transaction that ever had to clear in dollars. Lots of stuff ultimately has to clear in dollars. The system is overgrown, and so now, while there are some legitimate targets, maybe from the perspective of the United States, such as you might want financial sanctions on Russia for an invasion of another country, there's also a concern that the system has grown so unwieldy that sometimes it's very difficult for one party in one country to clear a transaction with another party in another country. So the global payment system is partially responding. A big part of this is there's some excellent research by Ricardo Rees at LSE and Sahim Bajaj at UCL looking at the rollout of China, the PBOC's swap lines, to set up swap lines between China and other countries. So for example, Argentina. Most Argentine-Chinese trade takes place in dollars historically. However, a recent episode involved a dollar shortage in Argentina because of their own macroeconomic imbalances. What did the PBOC do? They sent renminbi to Argentina, allowing Argentine firms to borrow from a Chinese state-owned bank in Argentina. They then invoiced all of their trade from China to Argentina in renminbi. And for the year that these dollar shortage took place in Argentina, it was something like up to half of Argentine trade with China switched into renminbi invoicing. So this was an attempt by China to, in some sense, do something sensible, facilitate Argentine purchases of Chinese merchandise when Argentina couldn't access dollars. But the system, and Russell's described one aspect, it's all very actively evolving and changing, and there's these different strands that are connected. So trade requires money, requires a payment system. At the same time, countries need to do basic things like provide a military to protect their citizens. They need taxes. What happens when we move away from an economy, when we're moving goods across from point A to point B, to moving more and more of the activity as a service, which is intangible and can flow across the border quickly. This is a real challenge for tax.
Right. Anything you want to say briefly?
No, I think you've covered that.
Okay. Let's now, opportunity for questions. If you would like to identify yourselves and your organisation, that would be a bonus. Who wants to set the ball rolling with questions on our presentations? Yes, we've got a roving mic. Let's start in the middle there. Yeah, there we are. Good.
Thank you very much. That was a really interesting set of talks. To what extent do you think that global trade imbalances have contributed to the fragmentation and tension we're seeing between countries like the US and China? And do you think there's a role for the WTO, the IMF, the FSB to be trying to tame these imbalances?
And your name and organisation?
Max, I work at the Treasury.
Right. And should we pass the question on for a second, pass the microphone on for a second questioner? Yes, there.
Hi, I'm Marcus from the Civil Service. Just another civil servant, sorry.
That's all right.
On pensions and mandates, how would that mandate actually lead into investment in the UK economy? And then maybe, Russell, a question about if France is in this situation, how would that affect the euro, the currency, and possibly the political union? Thanks.
Right. Yeah, let's start with Russell, because I think for some of it was quite striking the way you also identified French issues. So do you want to follow through on some of the implications of that, and perhaps also on, not touched on so far, but some of the British government's aims to acquiring pensions?
We'll talk, we can use a French word here, dirigiste, but we can begin with Macron, whose speech on the 26th of April last year at the Sorbonne, I think it changes the world. He said that it is absurd that Europeans send 300 billion euros to America every year. It is absurd that we fund America every year. He didn't say exactly what he would do about it, but anyway, he thinks it's absurd. The mandation that the British government has led off with, I think, is the new normal, which is that this capital is so necessary to fix the problems, social, political, at home, economic, financial, that it simply won't be allowed to go anymore. And mandation, these aren't my words, these are the words of the chief executive of Lloyds Bank. The mandation of the British government is the capital control. It is forcing, British institutions can sell any asset to put money into the mandated asset. But if you try selling gilts, I think you'll get a strong letter from the Treasury, I suspect. So it really is a repatriation of capital, and Macron wants to do it. The Germans are doing it already, and that will accelerate. So that's how that mandation plays into all of this. Trade deficits as they stand, current account deficits, have to be funded by capital flows. We, as an economist, you believe in choice and decisions of choice, but when you put in a mandation, suddenly everything is different. So that's why this really matters. So it's a repatriation of capital. I think it's initially in this country targeted at sort of growth assets, but it will, I think, come to British government bonds, and that's happened in the past, usually in times of warfare, but actually last time post-World War II. In terms of France, how long have we got? I mean, it's obviously imbalances in the euro is something you can go on about for a very long time, but in my opinion, that imbalance went from nothing to huge. Remember, it can happen like that because you're talking about a difference between two very big numbers. So something dramatic can happen. Was because Germany didn't need its savings. And now Germans have got 7 strategic errors of the last 20 years. And investment is the only answer for all of them. Whether it's power, whether it's decoupling from China, whether it's now decoupling from America, whether it's defense, they all require capital. So I would argue that the spread between French and German bonds will increase pretty dramatically as the repatriation of German capital continues. The next biggest investor in French assets is actually Japan. The Japanese, under the IMF coordinated portfolio survey, shows the Japanese have had a great appetite for French assets, and I think most people recognize that the Japanese will have to repatriate capital to try and shore up its own domestic bond market. So France is really in the crosshairs. So rising risk-free rates in France. It's interesting that President Macron wants to repatriate capital because he's the actual loser in a world that repatriates capital.
Right, very tough internal pressures for the euro with fiscal policy and national economies and an integrated euro. Do you want to comment, Sherman, your observations?
Not on that one. I'm on the real trade side.
But what about the first question about the WTO, the role of the WTO?
The WTO explicitly is on goods and potentially services trade. Has anything to say about the financial side of it, basically. So it's failing at the moment. The WTO is dead in the water at the moment. So it's not it's barely operating institution. I think what you may observe emerging is something new, basically organizing around some of the big trade agreements we've observed, like the CPTPP. Your point is absolutely correct. If you're going to be running these trade deficits, you got to worry about how they're financed. It's not something the WTO worries about fundamentally. Use of tariffs to do macro is probably a very bad idea. I mean, Trump wants to do tariffs to do bilateral trade balances. Makes no sense whatsoever, and is a very bad idea.
If a government mandates capital repatriation, there's no international organization that can do anything about that.
Nothing. Not the IMF.
The trade then has to adjust to the rebalancing of the capital, rather than the other way around.
Yeah. Yes.
Meredith, your observations?
So the WTO is founded on, I sort of think, 2 assumptions. One is the rules designed in 1995, so there was a relaunch, was designed on the presumption that the countries participating were democracies with free market capitalism of some form or another. So it could be a very socialist style capitalism, very laissez-faire style, British style capitalism. But one of the goals was to reduce the use of industrial policy and subsidies in high-income democracies. So in the 1980s, a big problem was perceived that taxpayers were spending too much money on what was considered to be corporate welfare. The WTO reined a lot of that in with rules, was totally unprepared for integrating an enormous state capitalism system of China. So it just fundamentally doesn't really fit, and the tools in the institution don't work for managing some of the challenges with China. So that's one thing. And then in terms of, are bilateral trade deficits the problem, or are trade deficits more generally the problem? So there's many different interpretations of the large persistent trade deficits run by the United States. One was Ben Bernanke's, what we call the Bernanke hypothesis. The reason why the US had such big trade deficits was because investment was flowing into the US because it was such a safe place to put your money, because the rule of law was very solid. There was once a time we all felt this way. The rule of law was very solid and the returns were predictable. And so that was driving the investment. So in general, in macro, we have 2 different views on, is trade driving investment, is investment driving trade? Ellen Ray at LBS is like a leader in this. And so I think generally we tend to think the investment flows are faster moving and they're driving some of this. But it's an active area of research, and I think the general consensus among economists is tariffs will not fix these problems, and the president's strategy is not going to get him to the goals he wants.
Right, and that's a lucid summary of one of the key issues, what the driver is. Let's collect these two questions here. Yeah.
Hello. I suppose this question is mainly for Russell. In a world of capital repatriation that is disproportionately located in the US today, the US will see borrowing costs rise unless you have financial repression from the Fed. Does this mean in your New World Order, Fed independence is a thing of the past?
Right, and your organisation?
And Simon from Capital Economics.
Right, and I think there's another question. Yep, thank you.
So this is again a question for Russell, and I'm Sharmila Whelan from Westbourne Research Services. So, Russell, in this new world, very interesting, where you've got capital repression, you've got governments needing inflation to inflate their way out of debt at an economy-wide level. What asset class are you holding? Because on the one hand, if you get 4 to 5% inflation, that's good for corporate earnings growth, and you'd hold equities. But on the flip side, if you've got inflation, and governments are trying to get people to buy bonds, that means the risk premium bond yields are going up. Or are you just sitting in gold and bitcoins? Cryptos would be totally out of the fiat money system and the abuse.
So to the first question, the financial repression is kind of contagious, and that's really what you're getting at. So if the rest of the world was a forced seller of US assets to buy the assets they were told to buy at home, bond yields in America probably would go up. They're forced sellers of large scale. Markets tend not to deal very well with forced sellers of a large scale. So it may well force some sort of response from America to force Americans to buy it. American institutions, based on the flow of funds statistics, are very lowly weighted in Treasury securities. So it can be contagious like that, whoever ever begins it. So yeah, look, everybody who's got a very high debt to GDP ratio probably has to inflate away their debt. And it may be these triggers that take us to that world. In terms of asset classes, well, there's actually lots of equities you can buy, and they're all everything that we currently buy from China we're not going to be buying from China anymore. We're decoupling from China. So there's a whole massive investment boom coming, which, as it's driven by the government, may ultimately destroy returns. But for some time, I think there'll be a large investment boom right across the developed world. I mean, Germany's going to be absolutely huge. And if one can buy the right equities in that, then one can profit from that. But the key question that the gentleman raises is this. If you're going to force institutions to buy government bonds, what are you forcing them to sell? That's the question. Actually, it turns out it's equities, and particularly US equities, where they're grossly overvalued. So there's a longer answer, but I think there's lots of companies you can invest in for this huge investment boom that's coming across the developed world.
Right. Do either other panelists want to comment on what, and perhaps also the inflation observation, because in a sense, when you see some of these, inflation does look like the classic answer to some of these problems. Any comments on that, Sherman?
No. Well, one important comment. We are talking in a lot of different places whether these tariffs will have an effect on inflation. And that's something you can look at. And the answer seems to be that trade is only a small share of the domestic market. So whether you get even a pass-through to the domestic market depends on trade shares and how substitutable things are. And the other point is, any of these tariffs, it's a one-time adjustment. It's not inflation. It's not a process going on. It's a one-time shot. So I think that's probably the inflationary impact of these things. We don't see it. With some sectoral exceptions. We had a big discussion in the U.S. when Trump first put on the enormous steel and aluminum tariffs, and the question was, one, would it pass through to the price of imported steel and aluminum in the domestic market? And the answer was yes. I mean, fully passed on. Would it affect the domestic production steel producers? And we had this discussion about, well, it's not a big share of the total market, maybe it wouldn't be a big number. And the answer is the local steel and aluminum producers raised their prices on the announcement of the tariff, even before they'd come into effect. That is a very imperfect market, and you were observing how monopolists work.
Right.
So,
Meredith?
So I guess I'm not convinced that we're moving to a world where we're going to have full capital controls among all of these high-income countries. I see that as very hard to put that genie back in the bottle. So I'm not convinced that's where we're going, but I could see maybe some direction. There is concern about this, and this comes in with the movement of tax and tax evasion or tax avoidance strategies. On inflation, I agree with Sherman. The main impact when you have a fragmentation of markets is that you get a sort of one-off big increase in the price level, but this is persistent, and it's a long-term shift of resources away from consumers toward other actors. And so just to give one example, because we're in Britain, I've been doing some work on some of the post-Brexit price increases. One of the interesting things we've found in this work I'm doing right now is a big factor was the cost of a lorry load of merchandise moving from anywhere in France to the UK basically rose by 30% when the trade and cooperation agreement came in force. So it went from 2,000 euro to move something from Lyon to Manchester to 3,000 euro. This is a very large increase. The interesting thing to me is we've been looking at different consumer goods markets, and what it looks like has happened is when the price of various French products went up, essentially pricing in this cost increase from transit, we see domestic British producers of similar competing goods raising their price much more than they need to. So I think one of the things is there's different benefits from free trade and integrated markets. One is competition keeps prices down because it forces firms to keep their price cost markup pretty low, their profit per unit. And so when you segment and fragment markets, you give a lot more market power to the local guy, and the few exporting firms that survive are the ones that are very efficient, but they also are going to be passing through the costing. They can absorb some of the cost increase, but they're still going to pass on a price increase ultimately. So big level increase, not good for consumers.
Thank you very much. Any further questions? I'm looking particularly at this side of the room. Yeah, I think there's a couple of, can we just try the other side of the room? Can we just,
we've neglected them.
Yeah, I'm trying to balance it out there and then further on. Yep.
Hi there, I'm Sital from the Cabinet Office and I work on trade. Meredith, your question about what do we do next, like what are the new foundations for global trade really struck me. And I guess my question is in two parts. First is there's been quite a lot of noise around MC14 and Dr. Ngosi's plans to reform the WTO. Do you think that would be successful? And second question, I guess, is there's equally been a lot of noise around CPTPP, including Ursula von der Leyen's recent comments about it being a replacement for the WTO. How successful do you think any of that might be?
Very interesting. And past the question, I think there was another question to that. Yep.
Yeah, hi there. My name is Nikos. I'm originally from Cyprus. So I happen to deal with, let's say, models regarding the Greek and Cyprus restructuring after the crisis they both faced last decade. I have a scenario for all participants if you wish to answer. So next Saturday morning, they call you from the United States and they tell you that President Trump decided to make you the chief economic policy officer for fixing the mess. What would you change in the next week? Thank you.
Right. Let's start with Meredith. And it's interesting, these questions about, I think for Brexit Britain, there was a belief that somehow the WTO and these international trading organisations would take a lot of the weight. And you're hearing still an interesting British policy debate, desperately trying to find some type of international trade umpire. And there's also the wildcard question as well. So your observations, Meredith.
Okay, so the WTO appellate body, which hears these disputes between different countries that just disagree about something, they're not interpreting the treaty in the same way, that's frozen. And so there's been this attempt to set up a side court around it to try to resolve the problems. To some extent, there's some usefulness of dealing with problems. So, for example, Turkey and Morocco get in fights over steel. There's no place for them to resolve it really all the way to the finish right now. They can do some resolution at the WTO, but it gets kind of stuck. An alternative mechanism to help finish the process for, say, Morocco and Turkey is a useful thing to add as an institution, but it's not going to solve the fundamental problem that the treaty is founded upon the principle of a domestic economy that can enforce its own law in a sort of confident rule of law is foundational. And if you don't have rule of law, or very arbitrary rule of law with an autocratic government, it's really hard to have a decision at the WTO ultimately implemented. So I think a very deep problem is how do you deal with China when they shift their own law, they're not a democracy, they can tax their people to any extent without having to take on board what the people want. So there's some very fundamental problems with the premise of the WTO agreements. I think von der Leyen is playing the Obama playbook. So this was exactly what Barack Obama was trying to do in 2009. He said the WTO isn't working, the rules have become hamstrung, we need an updating of rules. Let's get a big bunch of like-minded economies, US, Canada, Japan. Let's write a rule book. We'll ultimately have this rule book disseminated to the world over another decade. So now I think this has been revived as an idea. The fundamental thing that changed was the US stepped out of this TPP role. So I think there's some value to maybe going with trying to do another agreement, getting a bunch of countries together. But I think fundamentally there needs to be some thinking of, in international commercial transactions, what do we want to do and what should be a fair way to integrate a non-market economy, socialist economy without democracy with relatively capitalist systems where democracy is present. And that's very difficult in some ways to integrate harmonized rules there. So that's a trick. If I were in charge of US economic policy for one day and I could do just one thing, I would restart aid flows because I think the human cost of the end of USAID is a disgrace and a humiliation for everyone who's an American.
Right. Very interesting answer. Sherman, you're
Yeah, the point to make, basically the U.S. is no longer a trustworthy trade partner. That is quite clear. So what happens? If you are protectionist, then two things can happen. One is there's an incentive for somebody to build a factory in the U.S. in order to sell into this higher priced protected market. And we see that all over the place, import substituting. But not if you think it's completely chaotic. And furthermore, there are going to be tariffs on your intermediate inputs, and so your value chains get expensive. So, for example, in automobiles, we may end up with a situation with all the steel and all of those tariffs that the U.S. becomes a high-cost producer of the wrong cars. There's no reason you would invest in producing cars in the U.S. in that environment.
And your one policy option for your day in charge?
I'm with her. I think if you could put back it's not just the aid flows, but the aid flows are absolutely crucial. And the fact that Britain turned around and cut its aid budget in half, I thought was really not the right answer. Those are not big numbers, and what we're not observing the rest of the world picking it up yet. China may pick up some of it.
China stepped in the WHO.
And it has to some extent, and what you've done is then take the Europe and the US out of Africa in this purpose, and you've left a vacuum, and it's not going to be pretty.
Right. Russell?
Well, the reason we had Butskillism is that the debt is a constraint. Politicians are constrained by the debt. That's where we are, and that's a fact of life, and it's going to be there. So you need to deal with the debt. There are only 5 ways to deal with the debt, which would be default, austerity, very high real growth, hyperinflation, or financial repression. So, I mean, that's it.
Or raise taxes.
Well, That's a form of, I think I'd call that a form of austerity, putting up taxes.
Yeah, it is definitely kind of austerity.
Yeah, okay, so those are the 5. So we might as well realize that we're in a world where we have to do financial repression and get on with it. That's the world we live in. I mean, the point is, it's not as bad as you, I don't want to live in that world. But it's not as bad as you think it is. 1957, Harold Macmillan said, "You've never had it so good." He was right for the working men and women of Britain, but wrong for savers. He'd already lost 30% of the purchasing power of the government bond portfolio. So it is also a reallocation of wealth if wages grow, and wages should grow in this environment of massive investment. Debts would be, when you inflate away the debts of a nation, you're inflating away the debts of a consumer. Now, the consequences are you massively misallocate capital and end up as the sick man of Europe, which we did once before. But it can take 20 years to get there. So I would do that. And just one thing, because this gentleman's from Cyprus, I assume from Greek Cyprus. Your genie was put in the bottle because you did have capital controls, as did Iceland and as did Greece. Not completely. I think you'll probably tell me they didn't get completely into the bottle, but capital controls were able to put capital in the bottle, so they can work. Not effectively, not brilliantly, but 3 developed world nations have tried them in the last 20 years with significant success, if not total success.
Right. Let's collect some more interventions, starting in the front here and then 2 more on this side. Yes? Here we are.
Hello, thank you. My name's Chris Naylor. I'm a former Lib Dem PPC, amongst other things. And as we're at the Resolution Foundation, I've wondered if we could ask a little about winners and losers. That might be pushing you slightly off your direct economics brief, but Russell, in a way, has just started on it. And the winners and losers I'm thinking about are those higher income economies going to stay the higher income economies? Of course, that's the China question, which I park slightly. And within society, what do we think the impact of this might be, perhaps in some of those higher income economies that we know better? Are we looking at significant tensions or winning and losing, which might be a bit of a challenge? Thank you.
Very interesting question. And then there was another, if you pass behind you to the back, towards the back. Yep. Pass the parcel along. Very good. Gentleman there. Did you have a question? Yeah, fire away. Ask your question.
Yeah, so my question is, can you perhaps find parallels in economic history? Because what kind of comes to mind for me are times that I've studied, such as post World War I, where you had the German reparations, and there's issue around the extent to which they could repay their their kind of reparations via exporting to the kind of allied nations. That was a problem. So this kind of general issue that comes up in economic history of asymmetric adjustment.
Thank you very much. Yes, and along there.
Thank you. Martin Wheatcroft. I'm an advisor and author on public finances and a chartered accountant. My question is, who holds all the cards? There's been a lot of discussion about rare earth metals and the China's ability to hold that over the US. It seems to me Canada has a huge amount of resources that it provides to the US in terms of oil and lumber, etc. Have we misunderestimated the power of the suppliers as opposed to the purchasers?
Oh, and there's a lot of balance of power questions here. And I must say, Russell's analysis, and this answers the question about, does remind me that when I arrived in the British Treasury as an official in 1978, there was a maximum of £50 you were allowed to take out of the country under exchange controls, and rewards to labour were significantly higher compared with rewards to capital. And we have indeed seen, and we've shown this at Res, what you could argue that there's now been a massive shift in rewards to capital growing relative to rewards to labour and capital mobility. And I think what we've just heard from Russell is that a picture of a world which looks remarkably like the one where I started my adult career.
But you arrived just as we had successfully inflated away all our debt. So
and that's also true.
You inherited a very good balance sheet.
Yes, inflation has done its work, both for the national accounts and for all those people who are getting on the mortgage market. Meredith, your observations.
So for winners and losers, I think just an observation about the high income versus middle and low income countries. We know, I think circa 1990, but I guess saying in the sort of 20, 25 years to today, we've seen, roughly 1 billion people leaving dire poverty, less than $2 a day. And so there's been a huge increase in human well-being associated with China coming into the global trading system. At the same time, other measures the World Bank uses of people living on like $5 and $8 a day have basically been flat. So while the most dire in need have been doing better, the people in the tiers above them, those shares of global population haven't really shifted. So there's a lot of people in lower middle income countries who aren't doing so well. One would hope over time we get, there's more people being born, population growth, fertility are all higher in Africa than they are in North America, Europe, and Asia. So there's going to be a shift in activity, in a long term. And one would hope technology disseminates down, but the world is changing really rapidly, and there's been a lot of concern about we will de-industrialize in low and middle income countries before there's a chance for the service economy to take over. So it's not really clear globally where the winners and losers will ultimately be. Within societies, I think most of the high income countries are just seeing that people in the bottom quarter of the income distribution are generally not living more rich lives than they were 30 years ago, that their incomes have stagnated. This is across the board. It's just very difficult for thinking about how do we improve human well-being in high-income countries, and it's a challenge, I think, everywhere. I'll just say that the question about who holds the balance of power, that's a big question when we think about things like rare earths and mineral resources. Again, these things in the next 100 years are going to shift as the climate shifts. But something like rare earths, many of them were mined in the United States up until sort of the 1990s, and environmental regulation is what led the U.S. to reduce a lot of the mining activity. So some of this stuff can be done not just in China. The question is, in the location where it takes place, how much is that population willing to accept the environmental degradation that's associated with some of these mining activities? So if you put it in the far west of China that's very not inhabited, that might be a good location for it to take place. Same for parts of Australia, but there's a question of which of these minerals do we most need for the energy transition? Do we need all of them? As the prices change, we start to economize on some materials versus others. So it's probably, human beings are incredibly innovative. We can probably innovate something around that problem, but in the short run of 10 years, China does have a few cards here, and this is where a bigger problem is that the world needs to solve carbon and reduce climate change, and that's going to require cooperation, including economic cooperation between the high, middle, and low income worlds. So that's a big challenge. We can innovate some of these problems away, but it's going to be difficult, and some of it is going to require some shifting of who the winners are and who the losers are in different places. I'll leave the reparations question and the sort of historical parallels, because I think that's more about debt to Russell.
Right. And is there any final observation, however, as we ought to end at 7:30? You've just made some very interesting points. Anything else you wish to add, as this is your last chance before we break up?
I'll stop there because I feel like I sometimes overuse my time.
Well, you have made some very powerful points, particularly on US aid. And I should add, on rare earths, the British government, this may be the kind of world that Russell has been describing. The British government is now subsidising a lithium mine in Cornwall as part of its reaction to the environment which we know it.
One quick thought on the historical part. I've done a lot of reading in the last few years on the 1930s and the interwar period, because that was a very exciting period. There's some very interesting work on the commercial history of that period by an economic historian named Doug Irwin. You might well want to read it. There you had these big tariffs we put on, Smoot-Hawley tariffs, we're famous for it. It did set loose basically a trade war globally. And you ended up with everybody going protectionist and inward looking, and it was a disaster. I mean, it was not a good thing. That is not what we're seeing now. I mean, we are seeing something quite different, and I don't think that the 30s lessons from that are particularly relevant. We are seeing a world where you may well end up with the U.S. playing a very different role, and then everybody else has to kind of figure it out. When I look at it from the economics, I think, gee, you know, we have this Europe, we have these three big trade blocs. We have Europe and East and Southeast Asia and the U.S. The problem with Europe and East and Southeast Asia is they may be an economically integrated region, but they are not politically integrated in the same sense. And that's a major problem. You are seeing institutions in Europe starting to evolve, and maybe as an economist I'm just being over-optimistic about the Europeans' ability to do it. East and Southeast Asia, you're starting to see some of the institutions of the EU to do dispute resolution and all that kind of stuff. There's no Treaty of Rome anywhere in East and Southeast Asia. There's a myriad of cross-cutting trade agreements and other agreements. You are seeing some of that collaboration going, and China is a very important part of that story. And whether China behaves as a good anchor country in its economic region or is insisting on being some sort of imperialist empire, that's going to be a big issue.
Thank you very much. And Russell, you're the financial determinist here, with these financial flows shaping so much. Your final observations.
Okay, well, just on the metals, the G7 formed a metals club, so I think we should find out what that is. And the three additional participants beyond that are Australia, so that'll be Australia and Canada, are both in the metals club. China's not in the metals club for the avoidance of doubt, India and South Korea. So I think the metals club, the whole idea, because it comes at the tail end of a speech by von der Leyen about rare earths, is to, interestingly, obviously direct more of these products to the developed world, but does that mean directing them away from China? That's what China will think. That's what China will think the Metals Club is about. So there's a response coming. I don't know what the Metals Club will morph into, but clearly it's supposed to be something. And then in terms of that long-term thing, now most of us here will have started reading Mr. Piketty's book called Capital. And there may be even someone in here who finished it. I wasn't one of those. It's right up there with a brief history of time. But anyway, in page 27, there is a chart of wealth distribution. And what that distribution shows is a peak in the concentration of wealth in 1929. And the first breakdown, if you like, the redistribution of wealth comes through lots of rich people losing money, which turned out not to be good for anybody, really. But after World War II, there's another period, and that is the period of financial repression. And the inequality of wealth shrinks and shrinks and shrinks and shrinks. So the winners and losers are pretty obvious. Savers are losers. Old people are losers. Young people are winners. Debtors are winners.
Workers and people earning wages, and by and large, your model are winners.
And young people in particular, because young people's wages, even if they only grow at the rate of inflation, they get promotion every year, so they get slightly more than that. And if their interest rates never go up, they do okay.
You're beginning to win me over. Very good. Well, we've had a fascinating set of exchanges and have really... we've started with trade and tariffs, but we've also confronted deep questions about power in political economy and wider economic imbalances. Thank you to our three excellent panelists for your fascinating observations, and thank you all for participating, and thank you to the Royal Economic Society and the Society of Professional Economists for bringing you all here. Thank you very much indeed. Thank you.